So we use this 30 minutes to really clear up business deduction related to auto vehicle, related to car. It's a very interesting, it is very dynamic topic because, you know, questions would come to us from every angle. So it's almost like there's a lot of information, there's a lot of pieces out there. People know one thing, and but not sure how that fit in their situation. So hopefully, and what we're doing today is just really kind of systematically sort out the thinking of auto vehicle deductions related to business use. Hopefully that would help you when you fill out your deduction, your taxes. So I'm going to start sharing screen. And prior to beginning, and I always want to put this in front of you, I am serving on the Federal Advisory Committee to advise IRS at present time. It's a 3-year term, so this is my 2nd year. And this is the first book I have out, appointment with Ying at 8 a.m. and the 10 a.m. is coming up. So I'm doing the second one. The first one, starting up a business. The second one is growing your business. It is very different, let me tell you. And while I'm writing these books, and I really kind of draw a lot from the experiences that you give me, and every one of you out there who are our client really is author for the book as well, because I really do learn from you, and then I articulated that out without identifying you, but identifying that experience. The firm information, you of course know, and also no responsibility disclaimer, and it's so important, right? That's almost like, you know, American culture is about no responsibility disclaimer. In the way I'm kidding, but you know, in so many ways is real as well. Take information with a grain of salt. You know, the website I really go to for all of my information, I go to those professional association, like for CPAs, I go to ASCPA, and you know, for taxes, I go to IRS website, the state website, and I use those website to guide me. But I don't just go on Google's, look at everybody's information. You know, people can say things wrong, right? So, and having said that, same thing, Ying could be saying things wrong, and be sure to understand it and, you know, do better based on what I say, right? All right, so general guidelines on any business deduction. You know, one can really, you know, you're in business. If you don't deduct, you're going to pay more taxes. That's a given. Okay. And IRS not going to give you a trophy because you paid more taxes than you should. Actually, if IRS audit you and they realize that you actually paid much more than what you should, they give that back. They give the money back to you. They don't like you to do it more, to do it less. They want you to do it right. So their guidance is important. So let's look at the guidance about business expense deduction. They say the business expense must be both ordinary and necessary. That is really the overarching principle they have in the deduction, because it is impossible to micromanage every business on earth. Well, not on every business on earth, every business in US territory, to say that you have to do what, right? It's not possible. Your business is so unique. Some of the expenses that maybe people think that's not a proper expense, but it is necessary for you. So with that, and you really kind of need to, whenever you deduct something really out of ordinary, you felt like weird. A good example would be, we have this professional service company. It's actually a consultation firm. They actually spent money on baby diapers. So you would think that, come on, must be the owner's kids who wants, you know, who bought baby diapers, and then they deducted out of the book. So when we were working on the accounting, and our accountant would call the business owner, goes, well, there's like 3 bags of diapers, like $20 some a bag, and then $100 some. And is that a personal or that's a business? You know, that was our question, the question we have to our client. So we were asking that question. So what happened is the consultation business is actually consulting on a lot of family matters. So the kids are coming, husband and wives are coming, and so their bathroom, and they put the baby diapers in the bathroom to allow their clients to use that properly. Maybe a diaper went a little faster than usual, but still that is a reasonable business expense once you consider why they're buying it. So again, a ordinary expenses is one that are common and accepted in your trade, in your business. For example, food for restaurant, and computer cartridges for professional firm. So those are ordinary expenses. Unnecessary expenses is one that is helpful and appropriate for your trade and business. Helpful, folks, and appropriate. So, you know, here we wrote specifically for you that it does not have to be indispensable to be considered necessary. What does that mean is that it doesn't need to be absolutely needed to be necessary. It is necessary for your trade, and that a lot of it is a very subjective matter that when you get into an audit, if you ever argue a deduction, whether it's valid or not, reasonable or not, and this is just going to be up to you how you present your case. And so of course, auto vehicles, cars, here we're talking about, are they necessary? Are they reasonable? Are you deducting it right? So we are going to zoom into that. And the in relation to the cars, before I go into the deduction side, I want to tell you that there are businesses relying on cars, right? For example, taxi company, right? And you know, maybe your Uber team, and so those are businesses that relying on the vehicle, and that is become a tool. It's almost like you are a construction company, and you have these hammers and electronic saws, and those are tools. They're not luxury anymore. They're not just a vehicle that you occasionally drive anymore. They are your tools. So when they become your tool, the deduction sort of leave the auto section and went into equipment. I want you to kind of just understand that big picture. So when you use auto vehicles in a big way, like taxi company, then suddenly you're going away from what we are talking about today. You're really is going to treat that as your equipment in the way. Okay, so now let's look at what we are doing today. So today we want to talk about the car you use for business. So, you know, I want you to follow my thought. And when you have a business, first of all, you must have a business, right? So when you have a business and you also need a car, and who doesn't need a car to do business? I don't even know. I can immediately think of anybody. Or of course, if it is you are virtual, if you are a virtual provider, and I can imagine that you know, some of the companies, and they outsource their things to oversee, and those people don't have a car, they just do everything online. So, but most of our client, we all have car. Okay, so when you have a car, when you have a business, number one, then you also have a vehicle that serves that business, whether it's partial or full, and then you right away have choices now. So you say that, and is your car, so look at this chart. So we ask you a question, is your car only for business? You'll say yes or no. That's an easy answer, right? Yes, only for business. No, not, because I use it for taking my kids back and forth from school. So if you say no, then you have two ways. When you say no, it's not 100% for business. That's not a killer. It is okay. You can have your personal car for business. So you just have two ways to do it. One is actual expenses way. The other one is standard mileage way. Okay, so if you say that, yes, I have a business, yes, I use car for business, but I'm not using it 100%, then you got two choices. But what if you say, yes, I use it for 100%? Then that become a business vehicle, right? The only way for your business vehicle to be business vehicle, for you to say, yes, that's not even enough. What we need you to do is to put your business title on a business name on the car title. So the car actually titled under your business. So I always advise my clients that, you know, when you buy a new car, or when you have a personal car and you're gonna move that into business, become 100% business vehicle, and you need to update your title. So the title can still have your name on it. That's not a problem, because you might be such a small business that you only drive that car, nobody else. So you want the title to be your name and also business name. So because of your name is on it, when you buy insurance, you can buy it on your old rate because you're the only driver. So the insurance will not increase because it's a business vehicle. But because you have a business name on the vehicle, business name under the, you know, holds the title, so that allows you to treat the whole car as a business expense. So now I'm going to sit here, goes, that's a lot of things I can do to deduct. Now, so, you know, I'm going to give you examples for when the car is under business title, is totally a business equipment, business vehicle, and then your gas, your insurance, your car wash, your maintenance, everything I'm listing, and the car depreciation, everything goes into the business. So you really don't have anything to do with the car anymore. Of course, if you are, you know, just like a real business, when you use a business car for personal purposes, you really should be reimbursing your business of your gas expense and things that you owe to the company, right? So that is saying that, okay, I have a business, my whole car is for business. So that's on the chart on your left hand side. But if you don't use it 100%, then suddenly you have the standard mileage way to do it. You have actual expenses way to do it. So let's look at standard mileage rate. So when people talking about standard mileage, oh, what is my mileage rate is? And you know, that means, that just simply means that you are actually not using your business 100%. And not using your car 100% for business. Okay, so for 2020, this last year, for 2020, and the standard mileage rate for the cost of operating your car for business is 57.5 cents per mile. And in 2019 is 58 cents per mile, and 18 was 54.5. So you can tell that rate changes. And whenever you do mileage claim, and you actually can look at that rate, and I know the standard mileage rate is perfect for you when you are a business owner and you are trying to get reimbursement from your own company, you use the mileage rate. But what if you have a business that your employees are claiming standard mileage rate? You are, as an employer, as a business owner, you are not required to meet with IRS standards. It is not required. You reimburse employees the 57.5 cents is not required, and you can decide on your own rate. And for the department of for Iowa, for state of Iowa, and that rate is 39 cents. Makes sense? So that kind of give you an idea. The 39 cents was the cents that was the rate they used before. Maybe they changed today, but I don't know. So 39 cents was the rate when we were having 54.5. So make sure that you understand what I am saying. For you, when you have a small business and you claim expenses deduction out of your own profit, and you can use IRS standard rate, no problem. But if you are going to reimburse employees, and as a company, you don't have to go for standard rate, okay? If you use the standard rate, and you cannot deduct any expenses on the car anymore, because that 57.5 cents includes depreciation ratio, includes insurance, includes all the other, they calculated in already. Okay, so no other deductions and just standard mileage. And you may ask me, oh, what about I have parking? What about parking? Of course, you can count parking separately because that is not part of the coverage under the mileage. And so going how many miles has nothing to do whether you're going to pay parking or not, right? Actually depends on where you live. If you live in Midwest, a lot of parking is for free. Okay, and so this standard mileage rate is basically used for reimbursement. So let's say you claimed your business, you claim your business and you got a profit on your business, but then you realize that, well, I use my personal car for business. I didn't use it 100%, but I did use it. So I have this much mileage I can claim. Of course, for for $1,000 for 1,000 miles, and you would get for 1,000 miles, you would get $570 reimbursement already, right? So that's what you use to reimburse yourself, to create expense line for yourself to reduce your profit. And if you want to use the standard mileage rate, you must choose to use it in the first year when the car was placed in service. Hear me right. I'm not saying about the first year you bought the car. I am talking about the first year you placed your car in service. That means that maybe you started your business in 2021 and you have that car, you bought it from 2018. That's okay. You placed your car in service in 2021. So that is the when you place that in the business, that has to be the first year you're doing it for standard mileage. You cannot be doing it halfway. Oh, I already did the actual expenses method, and now I decided to do that. No, standard mileage starts from that particular car for the first year. And you can later on, you started on standard deduction, but later on you think that, well, no, I'm going to use actual expenses. You can do that too. And that you have to do that in later year, but the first year, when you want to use standard mileage reimburse rate, and that car has to be the first year in service. So if you lease the car and you decided to do a mileage reimbursement, then that mileage method has to go on for the whole lease term. If your lease is 5 years, you stuck with standard mileage rate. If standard mileage deduction, if you choose to be in the first year, you go for 5 years. So that is a special rules for the leased vehicle. There's some limitations on here. So there's some limitations I want to ask you. So want to explain that to you. So you cannot use standard mileage rate to reimburse for 5 or more cars at the same time, such as a fleet. So it's like a taxi, right? Or you just have 5 in the cars and you were using standard mileage, on all of the 5 cars. So that is not allowed. So here it says that if someone has 3 cars or 2 vans and uses them for business only one at a time, can they use standard mileage deduction? And so you first month you use 1 car, the next 2 months you use another car. So you always use 1 car, always used 1 car. Then that answer is yes, you can. But let's see the next one. Someone has a car and 4 vans for businesses, and the employees use all of the vehicles. Can they use standard mileage for the car? No, must use actual expenses for all vehicles. All right, so that is kind of the limitation of standard mileage rate use. And then other considerations for deduction. If you are self-employed and use car for business, you can deduct interest paid on the car loan. All right, okay? And can also deduct any businesses related to parking fee and tolls. That's what I was talking about. And making sure that you have adequate record for your mileage when you do claim mileage. And I tell folks that there's 5 things you must have for every entry of the total mileage you calculate. 5. Number one, you need to know the date. What day are you doing that? So that's number one. Number two, you need to know the starting point, from where, right? Starting address. Number three, ending address. Number four, the purpose of the trip. Purpose of the trip. And I'll tell you that there was an audit I gone through for folks, and they have the purpose like meeting client, visiting client. So they have purpose like listed like that. Not good enough. Not good enough. And I have gone through actual audit. The auditor want to see you writing the purpose properly. Meet with client because they need a signature. We need to sign these signatures so the policy can be effective right away. Meet with clients because I forgot something at their home and that is needed for concluding this case. So, you got to have details. So that's number four. What is number five? The last, you have to give the mileage total. And you will be like, what's wrong with you? The auditors can check. I already gave them the address. They can check on Google to figure out the miles. No. And you need to write down the miles. It doesn't have to equal to what's on the internet. Because sometimes you are like me, driving in circles, can't find place. And I'm really bad with direction. And so when I go to a place, other people takes 10 minutes. It normally takes me 20 minutes because I'll be writing in the circle and couldn't find the place. So if you're like me, you need the real mileage, not the one that from GPS. Okay, so those are 5 things I told you. And for mileage counting, yes, that's what that is. But you may ask me that, then if I do the actual expense, is that easier? It is not easier, but it is more clear, more easy to delegate. Because if you have actual method, then all the car expenses goes to your credit card or goes to your debit card. It landed on your financial statement. So you don't have to do this kind of outside booking. So it is more convenient to delegate when you have actual expenses versus mileage, right? And know that when you speeding, getting ticket, that is not deductible, okay? Any penalty, IRS don't want you to deduct penalty because that is non-deductible item. Now, let's just take care of our very small business client. And when you do 1040 and you have your small businesses under Schedule C, and this is the line number 9. Did you see that right here? No, I clicked it. So there's car and truck expenses. So number 9, this is the number that where you're gonna put your mileage reimbursement. And actually every software company, every tax software, they would help you to decide. So, the screen shows up, they ask you, are you doing mileage or are you doing actual? And some of the software even better, they tell you that, why don't you do both? I decided for you. But don't forget, if you want to do both, let software decide for you. You better make sure that that mileage is the first year for that same vehicle. Okay. And so that is so much about mileage, a standard mileage claim, right? So now let's talk about actual car expenses. So if we do a real deduction, we're not going to care about the mileage, Ying, and the 5 item you're talking about making me dizzy. And I'm not going to have time to write down whatever I do. And let me tell you, I have a client so many years ago, and she's an older lady, and she doesn't use Excel spreadsheet. So, but she has this calendar with her. And she was audited for the mileage side of things. So on the calendar, they show up the date with the little squares. And in that square, she normally would write down where did she go and, client name and the mileage, the mile she drive. And also she write down all the, follow-up things. Like after she meet with clients, she just write down what she need to do after that. So that calendar, I actually presented that calendar to the IRS agent when she was audited. and show the IRS agent that yes, she didn't really have anything so nicely laid out as 5 item on the spreadsheet, but this is something that kind of proves she has been documenting mileage concurrently and is not a constructed mileage log, so has much more credibility to it. And you can even tell that the writing is not done by the same day, same time, and it's just really trustworthy, that particular document I have. So she got all her mileage approved and no problem. So sometimes folks got audited by IRS, they don't have the mileage log. They don't have the mileage log. They do what we call the reconstruction. It is allowed. It is not illegal. It is allowed to reconstruct based on what you have. Maybe you look at your receipt, knowing which Walmart you went, you bought what, and maybe you were looking at your calendar to figure out what you do. So those reconstructed mileage log, it is just just ask for more scrutiny. It is not wrong you reconstruct it, but the correct thing to do is to have it there from the beginning. Okay, so again, mileage, standard mileage claim is labor intensive. Okay, now let's see the real car expense. The real car expense is including depreciation, license for the car, and gas oil, and the toll, and the lease payment. If you lease the part, the whole thing goes in, and the insurance, parking fee, registration fee, repairs, tires. What else? Car wash. What else? Car repair. Everything, right? So it's all in here. So if you use real expense method, and of course sometimes when you use expense method, you actually saying that, well, I use this car only 60% for business, and the other 40% is for personal. So what's going to happen to my actual expense? Very simple. You prorate that 60-40. Okay, so real expense is easier to track because it's reflected on your financial statement, reflected in your bank. You really don't have any need to do this mileage log stuff. And I snipped a little picture from internet. I thought it was cute. It tells us that the vehicle expenses actual method. See, it says business use percentage. They're saying that you need to prorate that. Gas, depreciation, fees, insurance, lease payment, repairs. You see, it's all here. And the standard method is also here. So, and just give you an understanding why people use standard, why people use actual. And I, sometimes client came, they would ask me saying that, oh, Ying, I want you to tell me which way is better. And do I use the standard or do I use actual? So I always tell folks that, is your car new? Is your car old? If the car is an old car, you might end up repairing it, and the repair of car is not cheap, right? So for that, I would stick with actual method, just because what if I spend $4,000 on car repairs, right? Then if your car is new, standard would be really good, because all you need to do is to just track on the mileage. There would be not many other expenses that affiliated with it, right? And of course, the use of the car is also important. For example, my client bought, he's running construction, so he bought this truck with I forgot the English term for it, and I'm speaking Chinglish again. It is the truck that with the thing on the back you can raise. What do you call that? Oh my gosh! But it's a truck that you can sit like a passenger truck, but the back is actually for construction. So that kind of vehicle, when they bought it, and I conclude that into equipment, so they don't really subject to the percentage of business. How could you drive your date on a truck like that? I would not do that if I'm a guy. So I would do a regular car instead of my what do you call that? Oh my god, I really wish you could tell me. Anyway, all right, so let's tackle something called depreciation. I know nobody liked me to talk about that, but I want to kind of give you an idea. There is a thing called this. Do you think this Marcus you know, how do you read it? I call it Marcus. Some people call NMACRS, and you know, some people, I call it Marcus because there's a famous philosophy person and created the theory of communist, and his name is Marcus. So I actually relate that to that name, so I call it Marcus. And it is called modified accelerated cost recovery system. It is a depreciation system, all the car falling into here. Okay, it doesn't matter what other car, the other method like straightforward, double straight, and whatever they do, and you focus on this one, is Marcus for the vehicle. And but there is an exception. So I brought this exception up because it is not whole definite, right? There is an exception to the rule. So if you use the standard mileage rate in the first year of business use, and the change to actual expenses method later on in the year, you can't depreciate this under Marcus rule. You must use straight line depreciation over estimated remaining useful life of the car. So I'm just giving you a exception, is that if the first year you brought the car into the business and you did a standard mileage deduction, and later on and you are using actual, then when you doing the actual, you can deduct depreciation. Remember, when you do actual, you can deduct a lot more things. That depreciation need to be calculated differently. And you cannot use markers. You have to use straight line. And even for straight line, you need to calculate the vehicle base differently. I would say that if you do that, you come to a CPA office to do that. Don't do it at home on your kitchen counter. It doesn't work. Okay. And if the second exception is that if you use the standard mileage rate, oh, did I put that twice in there? There is another exception. I don't quite remember. Now I repeat it twice. Okay, so this one you don't really need. I would say that the other exception is the other type of deduction. For example, there is a deduction method called 179, section 179. Of course, if you use that one, you don't use this one. So, you know, with the 179, and you actually write off your car immediately 100% with certain limitations, with, you know, you have to make money in general. So those are exceptions. And now let's look at, once we are following into this modified accelerated cost recovery system, then what kind of deductions you have. So I want you to look at just two big categories. One is car placed in service prior 2018. Why is 2018? So my next slide is actually placed in service during 2018 or later. You see, I just have these two big categories. So 2018 is a big deal. 2018 is the year that President Trump did Job Act. There is a new tax law came out, and that's why it separated the depreciation treatment. So now, before 2018, if you place your car in service, and in those years, you look at the left side, date placed in service, right? If you did that, and the first year depreciation is 11,160, see, that's how it goes down. So you go by those rules. The second year is 5,000, third year 3,000, then fourth years later is 1,875. So to further honing the concept of placed in service. Placed in service is not the date you bought it. You could be buying the vehicle a lot earlier, and then you decided, I'm going to get a new car for myself. I'm putting this old car in business. And then when you decide to put your old car in the business, and that is actually what means by placed in service. So it's the date that the car starts doing business for you. Okay, so that would be the depreciation for that. And then look at this, placed in service during 2018 or later. Now, it gets a little complicated right here, and it is separating into two categories. And the one category says that acquired before September 28, 2017. The other one is acquired after September 27, 2017. So they have a different first year deduction on your new vehicle that you just got. Look at that. So to make it really simple, you know that there is a cut on 2018 before and after. So the first year deduction is different. And with that understanding, then you know that when you look at your tax preparer's document, you go, why are you not deducting 18,000 for me? Oh, that's because that was prior to 2018. So then with this depreciation being this way, let's look at one question. And you are a contractor and driven your car for 20,000 miles during the year. Okay, 12,000 miles for business use, 8,000 miles for personal. What percentage can you claim as a cost of operating your car for business expense? Because your total mileage is 20 and the 12,000 is for business, and hopefully you have a good way to track why you say it's 12,000. And in this way, because you are declaring that you're not using the vehicle 100% for business, that's why you need to determine the percentage. Now it's 60% is the cost of operation that you can use for your car, and because 12,000 divided by 20,000, that's your 60%, right? So this is where you calculate what percentage of actual expenses you're gonna take. And then going back to our example earlier, and you will know that I'm just gonna go back to that actual car expenses that includes depreciation, all of these gas, tolls, all of these ones. Then you will take that whole amount with your usage. That will be what you deduct. All right. I think I gone over sometimes. I apologize. And if you have any question, and give that to me. And I actually have one question here. If I purchase a car for business and I choose standard deduction for the first year to take advantage of the depreciation, can I charge mileage the following year? If you purchase car for the business, I would say that it's under business title. You want to put that on the business title. It is definitely beneficial to take the whole car into business to write off that way instead of doing mileage. As soon as you do mileage, you have a whole set of book you need to maintain, right? So I hope that helps you. And thank you for your question. I'll talk to you again, right? And we'll talk again. Okay, bye-bye.